Hello and welcome to Age Partnership's first ever webinar. For the many people who have registered for today's webinar, we'll be covering frequently asked questions surrounding equity release and separating the facts from the fiction. Here we're joined by Age Partnership's award-winning equity release technical manager Simon Chalk and Richard Espley, Head of Equity Release at Goldsmith Williams Solicitors, one of the UK's leading law firms, to help us with this. So, Simon, can we ask you, why is it now that people are choosing to unlock the equity that's locked up in their home?
I think there's two questions in that. One is why are they doing it, and two is why are they doing it now. So if I take the first one, why are they doing it? Fundamentally, the reasons haven't changed. People want to have a little bit of their wealth out of their home because they've got lots of things they want to do with it. And at one end, we will see people using it for home improvements, say, which is a very common feature that crops up with our advisors. And we'll have them just wanting to top up a little bit of income. Right through to the other end, where some of our older clients perhaps want to use it to pay for care or make some adaptations to the house, just to make it more comfortable to live in. So the other part of the question, which was why now, it's a good time, but we'll always say that, of course. But it is a good time in the sense that people have amassed a good property value. On average, houses are around the £250,000 mark. There's a lot of equity in there. And people, I think, looking ahead to the future, are mindful that interest rates might go up. And so they're looking to take advantage of some very good value deals that are available today.
One of the main concerns that we've had is people saying they're worried about losing their home. Is this something that can still happen?
It isn't, no. It used to be going before 1991, but everything changed then with the formation of a trade body to which all of the companies that we recommend are members. And they offer certain guarantees. And the most overriding one for anybody is the right to stay in your own home until the last borrower on the plan dies or should move out into permanent residential care. So they will stay there, and I think that's quite important. Although equity release involves a mortgage, it doesn't really look like a mortgage, because if you've ever had an ordinary mortgage and you miss one or two payments, you know the lender will come knocking at some point. You could be up in court and you could lose your home. With equity release plans, the option to make payments is there, but it's not mandatory. So if you choose not to make those payments or change your mind for some reason in later life, you can do so. So that's fundamentally important. It means that the lender can't seek possession. But you are required, of course, to do a few things like with any contract.
Of course.
One of them is to insure the house. Well, who wouldn't? The other is to maintain it to a reasonable standard. Again, who would allow their house to become dilapidated? And the last one is that if you want to move anybody into your property, so they'll come and occupy it with you, friend, family, for example, you just need to let the lender know and get their permission first.
So I understand the equity release industry became regulated in 2004, which is obviously great. But what does this actually mean for the customer?
It gives them protection, and that's absolutely essential, because if you're going to take an equity release plan, you want to know that somebody else is out there looking after your interests. So if we start with, say, the design of the products themselves, the regulator makes sure that the provider of the funds is financially strong to allow them to operate. We all know what happened with the banking crisis, so we don't want to repeat of that. So the rules now are far, far tighter than they ever were and subject to greater scrutiny. So we know that the providers are financially strong in the first place, which is encouraging. The next bit is the advice bit, where we come in as Age Partnership being retirement specialists. So our advisors are all highly qualified, highly trained and very skilled in what they do, and it's all they do. They don't talk about any other areas of financial advice other than releasing equity safely from your home.
So the equity release market and the products themselves have changed quite substantially over the years. Can you explain a little bit more about this to us?
I think plans have evolved because people's circumstances are so different now. If you go back 30 years, then people retired at a given age. They were often forced to retire at a given age. They might get their little lump sum from a company pension and a watch, and away you go with a pension for the rest of your life. People don't do that anymore. We get people in their 80s and 90s who want to buy second properties for holiday homes, and equity release can enable them to do that. We get people wanting to make gifts to their family because they know that they're going to live for such a long time. They don't want to see the money passed across to their children who then might be 60 themselves. They want to do it now, and equity release can enable them to do that. So we've had a whole host of changes to the plans. They're unrecognisable from what they were even 10 years ago, taking account of what people want. And I think the key word here probably is flexibility. The
Yes.
plans are so different now in that you could take a little bit when you wanted it, for example, under what we call a drawdown plan. 2/3 of our customers go for those because they don't always have a need for a great big fat lump sum. They might want a modest sum to begin with, and then this cash reserve that they can dip into and take little bits for bits of spending down the line that might just crop up for them.
Is that something you recommend, the kind of smaller drawdown version?
Well, we certainly encourage clients to be cautious with how they withdraw money because it's a finite pot, of course. We don't want them to spend it all and then suddenly worry that they've not got any more money to fall back on.
This is to appease that worry in later life.
Oh, absolutely. But we get all sorts of people, you know, and on one hand we'll have those that need or want to get as large a sum out as possible, and we can achieve that for those kind of customers. And we have others who don't need that. They might just have a very simple need to top up income, say, and most people only want a few £1,000s extra a year. And a drawdown plan can enable them to do that.
Is taking out equity release an expensive option?
No, I wouldn't say so at all. I mean, obviously there are costs involved in releasing equity because you'll be given advice, you'll have a solicitor to pay, and there will be a survey of the property. But there's a number of things here that can help alleviate it. First of all, no customer would ever go ahead with a plan until they had the costs outlined to them in writing. So they know what the cost is for that particular plan, for their set of circumstances before they proceed. Secondly, the advisor can help offset some of those costs because with us being a large player in this market, having a lot of customers, we agree the best possible terms for our customers with the providers. So we get common things like free surveys and cashbacks, which can help meet many of those costs. And last of all, it can be factored into the plan. With the right advice for the right client, we can make sure that the money comes out of the plan to pay for them. So rather than people dipping into their savings and worrying about that, usually...
As you can do with a mortgage sometimes, so you can add the fees on. Obviously this is separate to that, but you can, if it was a worry for you, you could have it within the plan, and then that would be another cost that you didn't have to worry about at the time.
Absolutely, that's right.
So some people might say, well, surely isn't it just cheaper to downsize and move home and get the money that way?
Well, we like to have that conversation with our customers and just check that they've really investigated downsizing as an option. Chances are by the time they speak to us, they're not daft, of course, we don't treat them like idiots, and they have already looked at it and they know what the home prices are in the areas that they choose to live, and they know about the costs of moving home with the estate agents and stamp duty on buying and solicitors and all that sort of thing, plus the moving cost. But do you know what? I think what drives it for most of them is the emotional aspect. They've been in their home probably, not always, but for many, many years. They might have raised their family there. That's where their treasured memories are. And they've already made a decision that at their point in life they don't want to move, and that's why they want to look at taking some money out.
So Simon, could you explain to us, how do people pay back the money that they've borrowed through an equity release plan?
They have options, lots of options. The more traditional form of plan, the one that I would say probably 90% of our customers choose, is one whereby they don't make any payments. They aren't forced to make any payments. So instead, the interest is added to the loan. So the loan will increase over time. Eventually, the house will be sold, usually because the last borrower has died or moved into care, or they just choose to sell it and pay the thing off. And that's when the loan comes to an end. Other people, of course, don't want to see the loan increase in value. They want to keep more of the equity intact, either for themselves to use later in life or to maybe leave behind for somebody in a will. So for those people, we can recommend a plan whereby they can either pay all of the interest every single month, but they're not forced to. So if they change their mind, perhaps if one person passes away and the pension disappears with it and it gets a bit tight, they can stop those payments at that point in time and then begin to roll the interest up against the loan. Or from day one, we have certain plans whereby a customer can even choose to pay back some of what they've originally borrowed. So we getting into the technicalities of a particular plan.
Yeah.
Quite simply, you can put little lump sums back into it if you wish to actually reduce the amount that you've borrowed over a period of time.
Equity release is a big decision for many people. Is there anything else right now that you could tell homeowners that they might need to know when considering equity release?
Yes, I suppose so. My top tips, if you like. Number one is take your time and do a little bit of research and get to understand the plans before you decide to go ahead. Two, and this is optional of course, discuss it with your family, particularly if you intend leaving them your home or some of the value of your home in a will, say. So that's quite important. Make sure that the advisor and the firm that you're speaking to are genuine specialists in the marketplace And a simple way to check that is to visit the Equity Release Council's website, where you can find an advisor and make sure that your advisor is a member of the trade body, and that way you will have all the safeguards that you need, that you're dealing with a specialist who knows what they're doing. Other areas that are worth considering, certainly, and we help clients with this in this respect, is to look at the impact taking equity release might have on any entitlement to things like grants for improving your home, means tested benefits, or if it might have a bearing on your own tax position. Because the last thing we want is a customer to benefit by taking equity release, to find out later on that actually it wasn't the best thing to do. So we get everything in the right order and help them get to the end whereby they know that they'll be better off by taking equity release.
Thank you so much for that, Simon. We're now going to go across to Richard, who's going to tell us a little bit more from a legal perspective. So Richard, could you explain to us what the role of the solicitor is in all of this?
Sure. The role of the solicitor is to provide the client with independent legal advice. Every client coming to equity release will have received independent financial advice from a suitably qualified professional. The solicitor's role really is not to decide on whether equity release is the right thing to do, and not to say whether the plan that the customer's chosen is the right one. Their job is to explain the risks and rewards of that particular plan.
So one of the questions is, can I move house?
Yes, you can. An equity release mortgage can be transferred to another property, but it's important to remember that in doing so there may be some associated costs, perhaps some legal costs for the administration for moving the mortgage, but also surveying costs for the new property, and perhaps your own costs in relation to moving home and removals, etc.
Well, I've had another question. That's, who sells the house when I die?
Okay, once the last of the occupiers has passed away, the plan has come to an end, and the mortgage has to be repaid. The usual way that would work is that the executors, your executors, people looking after your will, or other beneficiaries, would be responsible for marketing the property and repaying the loan. There's normally a fixed period of time that needs to be done within, typically 6 or 12 months. But obviously the other option is that the estate could pay the loan back, and the beneficiaries could decide to keep the property and not sell it.
We hope that we've helped dispel some of the myths and most frequently asked questions surrounding equity release today. And if there's anything else that you would like to ask, please get in contact with Age Partnership.